Hey guys, how's it going? It is Saturday, August 8th, and obviously the market is closed because it's the weekend. I've gotten a lot of questions this week in the YouTube comments, but also in the Discord server, where I have seen a lot of people asking whether it's a good option to roll their options out, or they phrase it another way and say, should I roll my option out, or when am I supposed to roll my option out? Or is this a good play? And I just want to make a video kind of addressing that, because the real answer to that question is it all depends on what you want to do, because there is no right answer. And the reason there's no right answer is because nobody can predict the future. Nobody knows what a stock is going to do in the coming week or weeks to determine whether rolling an option out is a smart play or not. It always comes down to a risk versus reward ratio, and so you have to decide for yourself if it's in your best interest to roll the option out or not. And so I wanted to create kind of an example scenario in this video to basically give you the education or the tools so that you can decide for yourself whether you should roll an option contract or not. So for this example video, I'm going to use Space or Virgin Galactic as the ticker here, and this is the Thinkorswim platform. So it's a little bit different than Robinhood, a little bit more complex, a little bit more complicated, but it gives you a lot of interesting information that Robinhood necessarily doesn't. And I thought that this would be an easier way to demonstrate what I'm going to talk about. So this right here is the option chain for Space, and you can see here, this is the option chain for this week's expiration date. So you can see right here in the corner, this is for August 14th. So I'm just going to erase that so it doesn't block the view. And what we can see is that currently Virgin Galactic closed the day at 1825. Now for this example, let's pretend that today is Friday, August 14th. So let's pretend that you own an option. Let's say you sold a put at the $18 strike. So let's say you sold on Monday, earlier in the week, you sold this strike. So you sold an 18 put on Virgin Galactic or Space that expires today, August 14th. And as you can see, the premium, let's just say the bid-ask spread is between 71 and 74. So let's just say it's $72. That's the premium, just to keep it an even number and easy to remember. So let's just say that right now, this option is worth $72, okay? So now, let's say it's about midday Friday, and you're getting a little nervous, right? Because right now, the stock price is at $18.25, your put is at 18, so if the stock price drops another 25 cents, or actually 26 cents or so, then you might get assigned 100 shares of Virgin Galactic. So then you're asking the Discord server, you're asking the YouTube comments, hey, should I roll this option out? And that's a great question. So in this scenario, again, we are assuming that today is August 14th, the day of expiration. Let's say it's about midday. You have a few hours left before the market closes, and you don't know what the share price or what the stock is going to do. Well, you have one option, which is just let it ride, collect your full premium, and if you get assigned shares of stock, you get assigned shares of stock. If it closes above 18, you don't get exercised and you collect your max profit, right? So that's your one option. Just basically just set it and forget it and let it ride, and whatever happens, happens. And if you get assigned shares of stock, well, then you'll just run the other half of the wheel strategy and you'll sell covered calls on it next week. Or you could say, you know what? I don't want to risk getting assigned shares of stock. I want to roll this option out for a later date. And if you're not aware what that term means, rolling an option means closing out your current option and then opening up another option at the same time for a later date and maybe for a different strike price. And there's no set time frame. You could roll an option out for another option the following week. You could do it 2 weeks out, 3 weeks out. I mean, heck, you could even do it a year out from now if you wanted to. But that's the real internal question that you're going to be stuck with is, do I want to risk letting this stock do whatever it wants to do, whether it goes up or down, and possibly me getting assigned shares of stock? Or do I want to not take that risk of getting assigned shares of stock and roll that option out to give me more time to be profitable, or more time for the option to work in my favor? Because, for example, if we roll this option out till next week, well, maybe space rallies hard this coming week, and space is trading at $24 next week. So then your rolled strike, which may be the same at $18, is definitely secure. And now you've made a successful option trade and not have to get worried that you're going to get assigned shares of stock. So really, the fundamental question is, how badly do you want to get assigned shares of stock, or how badly do you not want to get assigned shares of stock? For example, if you're playing some meme ticker and you were hoping just to collect premiums and you didn't want to get assigned shares of stock because you think that stock is a meme, then you may want to roll the option out because it's a meme stock, so you don't know if it's going to go to the moon tomorrow or if it's going to go to zero tomorrow. And obviously, if it's a penny stock, those stocks are very volatile. So, that's almost as bad as a meme stock where you don't know what's going to happen. So you may say, you know what, I definitely don't want to get assigned shares of stock because this thing could go to 50 cents tomorrow and I'm going to lose all that money. So if that's the case, or if that's what your mentality is, that you definitely don't want to get assigned shares of stock, then you definitely want to roll your option out to a later date and maybe even a lower strike price, depending on how the premium values work out. So let's say, like I said, today is August 14th. Your option is expiring today. You have an 18 put on. The stock is currently at $18.25 and you're getting nervous. You really don't want to own Virgin Galactic. You're not really too bullish on them as a company. So you don't want to end up bag holding 100 shares of this stock. So you decide, okay, I'm going to roll this option out. So now the next question you have to ask yourself is, for how long do I want to roll this option out? And also, what strike do I want to roll it out to? So let's just say we look at the following week's options. So we're going to open up this option chain here for August 21st, which is the following Friday. And you can see, if we look at the same strike, the 18 strike, you can see that, let's just say the bid-ask spread is between 106 and 116. Again, just to kind of give it a whole number, just for example's sake, let's just say the premium value here is $110. So what that means is, right now, it would cost you, and again, this is just for our example, $72 to close your current contract. So that would mean that, I'm just going to doodle here on the side here, you would be minus $72, right? Because you have to buy this option back to close it. That's probably the ugliest 7 I've ever drawn. Let me redraw that. So there we go. That's better. So you're going to have to pay $72 to buy this option back in order to close out your position. Now you could just say, you know what? I don't want to deal with this stock anymore. Let me just take the $72 loss, close out my position, and call it a day. I don't want to deal with Virgin Galactic. I don't want to roll it out. I don't want the stress at night. I just want to sleep soundly. I'm okay taking a little bit of a loss at $72, and I am out of this trade completely. I don't have to worry about it anymore. That's another option, right? But let's say you just don't want to take a loss, right? You'd rather collect $1 total than take a loss of $72, which is definitely understandable. So what you can do then, you're going to pay $72 to close out your current option. And then if you wanted to roll it out to, let's say, the next week at the same strike at $18, you would now collect $110 in premium. So yes, you paid $72 to close this out, but at the same time, you're going to gain $110 because now you're selling this option for the following week. So just to do some quick math here, 110 minus 72 is $38. So that means you are still net positive $38 in this rolling option example. And you're still at the same strike price, but now you've given yourself one extra week for the stock to move in your favor. So you basically bought yourself time. But really, buying yourself time is not a good way to phrase it, because you actually collected money. You didn't have to pay for it. You paid for it a little bit in time, if you want to think about it that way, because now your total premium that you collect will be over 2 weeks of trading as opposed to just 1 week of trading. But again, at the end of the day, profit is profit, and any profit is better than just taking a loss. So that's one strategy you could do. But let's say, you know what, you think space is going to hover in the 18s or 19s next week as well, and you want to give yourself a little bit more of a buffer between your strike price and the share price. That's definitely doable too, because as long as you collect more premium than what you're paying to close out your position, you're still going to be profitable. So you could say, you know what, I want to try and roll it down to $17.50 here. That way I have an extra 50 cents of buffer in terms of where I would get assigned shares of stock. But as you can see, by rolling down to a lower strike, you're also going to collect less premium. So let's just say the bid-ask spread here is 82 to 94. Let's just say it's $90. Again, just to keep it as a nice and even number. So that means that instead of collecting $110 in premium, you are now only going to collect $90 in premium. So obviously, your net positive value is going to change, because now you're not going to be up $38. You are only going to be up $90 minus $72, so $18. So yes, you're a little bit less profitable, but the pro is that you've given yourself more of a buffer by rolling your strike down. So not only have you given yourself time by rolling it to the next week, but you've also given yourself more space between the strike price of your option and hopefully the current share price. So that's another thing that you can do in terms of rolling your option. But like I said, you don't have to roll it out for the next week. You could go 2 weeks out, 3 weeks out. Heck, I mean, let's just say we go all the way out to September 18th. So that's almost a month away. So you could roll it out a month. And obviously, the farther you go out in time, the more premium you're going to collect. So for example, let's just say you want to roll it out to 18 strike a month from now in terms of the September 18th expiration date. Well, as you can see here, the bid-ask spread is now between 207 and 219. So let's just call it 210, again, to make it a nice and even number. So now, your calculation, this $90 is going to change to $210. So you're going to pay still $70 to close out your current option, but now you're going to gain $210 because you've given yourself a lot more time for that option to work in your favor. And obviously now the total premium, or your net premium, is going to go up as well, because now it's 210 minus 72, which is going to be $138. So now you've given yourself a lot more time for the stock to move in your favor. You've collected a lot more premium, about $138 net, and you've kept your same strike. But again, along the same vein, you could roll this thing down to a 16 strike, right? Because as long as you're collecting more premium than what you're paying to close your current option, you're always going to be net positive. I mean, the 16 strike here is between 96 and 108, so let's just call it an even 100. So then, instead of 210, you're going to collect $100. So obviously, you're going to collect, again, a little bit net profit, but that's going to be less than this. Your net profit now is only going to be $28, but the benefit now is, yes, you've given yourself more time, but also you've given yourself more of a buffer, again, by rolling your strike option down as well to, let's say, 16 in this example. So that's what kind of goes through my head in terms of my strategy or how I roll an option out. But the real question is, do you want to roll the option out? And that is going to depend on your hypothesis for what you think the stock is going to do. Because if you think that this week was a fluke, or this week was a bad week, or the stock got beaten down because the market was down overall, and you think that the stock is going to rebound next week, well, it may be better then to go ahead and just get assigned shares of the stock, because that way the following week you can go ahead and sell a covered call on it. And you may make more money that way by selling a covered call, and then you can hopefully get the stock called away, meaning you can get rid of your shares while collecting premium at the same time. So for example, let's just delete all this, and let's say, you know what, right now, like I said, I have an 18 strike put that's open on Space. The stock is currently trading at 18.25. And you know what? You're just watching the graph all day long, and it just keeps slowly dipping down all day. So you know that at the end of the day today, on the day of expiration, Space is going to close below 18, and you're going to get assigned shares of stock, and you're okay with that. That's fine. So let's just say, hypothetically, Space closes today at $17.50. So because you have a strike at $18, you're going to get assigned 100 shares of Virgin Galactic or Space at $18 a share. So $18 is your cost basis now for all of your 100 shares. And you let that happen because you think that the following week, Space is going to rebound. Maybe they have good news, maybe they have earnings, and you think they're going to do well on earnings. For whatever reason, you think that Space is not fairly valued right now. It's got beaten down, and it's actually should be worth a lot more. It's undervalued currently. So then if you look at the following week's option chain, because you got assigned shares at $18, to complete the second half of the wheel strategy now, you're going to be looking at selling covered calls. So in this option chain, the puts are on the right side, the calls are on the left side. So again, you're going to look at the very least, in my opinion, the 18 strike calls, because that's your cost basis. So you really don't want to sell calls below your cost basis, because if your shares do get called away, you might end up losing money depending on where your break-even point is. But as you can see, in our earlier example, we would only collect about $38 in premium for rolling that put out for another week. But if you're bullish on the stock and you're okay getting assigned the shares, you can see that if we were to sell a covered call on Virgin Galactic, you're going to collect somewhere roughly around $130 to $140. Obviously, these option numbers are going to change because this are the option premium values for today, which we are assuming is August 14th. You're going to get assigned shares of stock over the weekend, so these numbers are going to change when the market opens Monday. But it should be safe to assume that it's going to be around, let's just say, $130 in premium, roughly. So obviously, if you were to sell a covered call after getting assigned shares of Space, you would collect $130 next week just by selling the covered call. And let's say your hypothesis is correct and Space does rally to, let's say, $20 on August 21st, end of day. So that means you get to keep your full premium, so in this scenario, about $130, and you'll get your shares called away. So now you're completely out of the trade, but you've collected $130 roughly on the covered call side. You've collected your max profit, about, let's say, $72 on the put side. So you've collected about $200 round trip by running the wheel. I mean, that is basically the wheel strategy in a nutshell. You sell puts. If you get assigned shares, you sell covered calls. Hopefully your shares get called away, and then you're all cash again, and you can start the wheel with another stock or the same stock at a different option or strike price, whatever you want to do. But that is the wheel strategy in a nutshell. And that's why I say, when people ask me or ask in the chat or in the forum, should I roll my option out, or how do you decide to roll an option out? It really starts with, one, how badly do you want or how badly do you not want to get assigned shares of stock? But also, what is your hypothesis in the coming days or weeks for the stock? Because if you're bearish and you think Space is going to keep dropping, then obviously you want to avoid getting shares of stock, and your covered calls are going to be worth even less because they're going to be even further out of the money. And also, you don't want to end up bag holding, right? So if you're very bearish in the stock, then you may not want to get assigned shares, right? Because why would you want to hold shares of a stock that's just going down? That's like you just going down with a sinking ship. You only want to hold shares of stock if the stock is going up. So those are really the two fundamental questions. Is what do you want to do? Meaning, do you want to avoid getting shares of stock, or are you okay with getting assigned shares of stock? And secondly, are you bullish or bearish on the stock? So I hope that clears things up for you. And that's why when people ask essentially random strangers on the internet what they should do with their options, it really shouldn't matter what our opinion is. You should really do what you think based on what you think the stock is going to do. That's really the fundamental question here, is what do you think the stock is going to do in the coming days or weeks? So if you have any questions or comments, obviously leave them below. Better yet, join the Discord server while it's free. There's a lot of helpful people in there sharing a lot of good advice. So make sure you get in there if you haven't already. And as always, happy trading.